Assalamu alaikum wa rahmatullahi wa barakatuh. Hi everyone. Rabbi shrah li sadri wa yassir li amri halil uqdatan min lisani yafqahu qawli. I am Ibrahim Kabir Abdullahi from Nigeria, a student, a PhD student from Faculty of Forestry and Environment under the supervision of Dr. Amir Hamza Sharai. So I'm here today before you to present a lecture on one of the organs of life cycle thinking, which is life cycle costing. As we know, life cycle thinking has many organs, such as life cycle assessment, social life cycle assessment, and many more, and final and life cycle costing. So today we are going to know what is life cycle costing? Why do we use life cycle costing? What are the advantage and disadvantage of life cycle costing? And by the grace of God, at the end of the lecture, we may be able to understand the importance of life cycle costing. So here I said, why do we use life cycle costing? Look at some charts, some colors, and shapes containing uh, something like project engineering, maintenance engineering, shareholders, production, accounting, reliability engineering. So this life cycle costing can be used as a management tool decision or as a management decision tool for synchronizing the divisional conflict by focusing on facts, money, and time. Of course, yes, of course. If you want to initiate a project, definitely you must need to know the cost of such projects from the beginning of the project to the end of the project. How much will you spend? Will you be able to gain some profit, or are you going to lose? And at the same time, how much or how much time will it take you? Will it be long, last long, or will it have a short period of time? So for this, you can look at this table. As we see earlier, the colors, which with the shapes with some colors. For example, it contains project engineering. The project engineers always want to minimize project capital cost. For this, they build assets. These assets are roads, bridges, dams. For this, they must analyze the cost and time that will take them to build such bridge and the time that such bridge or dams or roads will expire. Then maintenance engineers, they always want to minimize repairs hours. Production wants to always maximize uptime hours. Reliability engineers, they always want to avoid failure. Accounting or accountants, they always want to maximize project using net present value. Shareholders, they always want to increase stakeholders' wealth. So for this, why these people need life cycle costing? So we are saying life cycle cost. What is this life cycle cost and life cycle cost? So life cycle cost is different from life cycle costing. This life cycle cost refers to the total cost of ownership over the life of an asset. It also commonly known as cradle to grave cost. That is from the production or from the start point of such product or project to the end of it. That is to the end of life, to the end use of such project or project or product. So life cycle costing is what? It's a methodology for the systematic economic evaluation of life cycle cost over a period of analysis. So it's systematic economic evaluation. Systematically evaluate the economic impact of the life cycle cost over a period of the analysis of such product. So we have another word which is whole life costing, which has a broader scope than life cycle costing, which is a methodology for systematic economic consideration for all whole life cost and benefits over a period of analysis. Note, you have to know that life cycle costing can address a period of analysis which cover the entire life cycle or selected stage. You can analyze the whole life cycle of a product or a project, and you can select some stages and analyze it. So anyone you have interest in, you can make analysis on such. Life cycle costing can also be an assessment of all costs related to a product or services over the entire life cycle, as we said earlier, from production or use until disposal. That is the production of such material or such product to the use of the product until to disposal, end of life of such products. We have three different types of life cycle costing. We have conventional life cycle costing, which is life cycle costing, which is CLCC, and environmental environmental life cycle costing, which is ELCC, and we have societal life cycle costing, which is called SLCC. Here we have a brief definition. We can see a brief definition of each one of the type of life cycle costing. The conventional life cycle, we said, is an assessment of all costs associated with the life cycle of a product that is directly covered by the main producer or user or in the product life cycle. The assessment is focused on real internal costs, sometimes even without end of life or use cost of this are borne by other. So in this case, conventional life cycle cost is a portion of life cycle costing that include only internal costs. You can only analyze the internal cost of a product. You can select some portion of the life cycle of the product and analyze it. For example, to know the internal cost, to know the cost, total cost of maybe producers or total cost of consumers without to the end of, for this we can say from cradle maybe to get, from cradle to grave, from cradle to from get to get analysis. So environmental life cycle costing is the assessment of all costs associated with the life cycle of a product that are directly covered by one or more of the actors in the product life cycle, such as suppliers, manufacturers, user or consumer, and end of life actors, with the inclusion of externalities that are anticipated to be internalized in decision relevant future. So there are two things. Conventional only focus on internal costs, while environmental focus on internal with the internalizing of the external costs. Here, we need to know what is this external cost. As we know, the internal cost is the additional of the total physical cost that you spend for that project. So what is external cost? Here we can say an external cost can be an impact, can be something that will impact the third party that are not known. You get what I'm saying? for example, the impact of the production of such products externally that will affect third party, not only the internal, those that are involved in the products. So there are positive externalities and there are negative externalities. The positive externalities, when the impact is beneficial to the third party, can be a positive. And when the impact, when the impact is harmful to the third party, that can be regarded as negative externality. So the final one is societal life cycle costing, which is the assessment of all costs that has association or is associated with the life cycle of a product that is covered by anyone in the society. Here, you must involve everyone in the society. It means that the analysis must be from cradle to grave, from the production to the use to the end of life of such product, and you must include all externalities, further externalities of externalities costs. That is, for example, based on willingness to pay or willingness to accept. Life cycle cost stages. We have different life cycle cost stages, or we have about 3 to 4 stages that are involved in the life cycle cost. One, we have acquisition cost. This acquisition cost is the first stage of life cycle cost. You need to know how much will it cost you to design the product. That is, you must spend money for what? Design, or for the research and development of a project or a product or a system that you want to make. Then operational cost, operating cost or operational cost. You need to find the cost of failures, cost of repairs, cost of spares, downtime cost, loss of production are all part of operational cost. And third one is maintenance cost. Maintenance costs are example of cost of corrective maintenance, cost of preventive maintenance, cost of predictive maintenance. You must all analyze such costs. And the final one is disposal cost. These are the 4 stages of life cycle cost. And aspects of life cycle costing. These aspects of life cycle costings are, we need to know 2 important points. One, we need to focus on the product cost. You have to focus on the product cost first. And secondly, you have to know the inclusion of, you have to include all the upstreams and downstream costs. This is the internal and external cost of a product. You must include each one, which is very important when analyzing the life cycle cost of a product. 2, a product life cycle, that is PLC, may be classified into 3 broad stages, which is planning and design, manufacturing and sales, service and abandonment. This I'm going to explain the stages of the product life cycle. 1, planning and design stages. Research and development costs, cost of product design, etc. are all part of the planning and design stages. Then second stage, which is the middle stage, is the manufacturing stage that witness both growth and maturity in sales. Every product that you produce must have after production, you must notice the growth of such products until the maturity, whereby it reaches its peak. Then from there, it must decline. That is to the end use of such products. So you know, we must monitor the cost of such growth and maturity, or growth and maturity in sales. All the manufacturing, marketing, selling, and distribution costs are incurred in this stage. And final stage is what? The abandonment stage, or we can call it a service and abandonment stage. This stage is signified by a decline in a sales volume. The demand for the product declines at this stage. The producer may be required to provide after-sales service for the already sold products. That is the end of life. So this is the chart, or you can say the graph showing the introduction, growth, maturity, and decline of the product. When we say introduction, it means that the first stage, that is research and development of the project or of the product. Here is a cell. Look at how the graph shows. From initial, it grows to the growth, that is going up to the maturity. It is go to the peak of the product until decline. It is started decline. So it is over time, over a period of time. So life cycle cost calculation approaches. There are some important calculation for the life cycle cost. These calculations must consider two approaches. One is deterministic approach, and second is probabilistic approach. The deterministic approach is using the exact cost for the product. Here we can say an exact cost will be determined. Then probabilistic cost, from the word probability, we know must be a range of values with a specific probability distribution. Here you can just sample a numbers and analyze. So here is some more details on deterministic approach. Fixed discrete value are assigned to various parameters, and any type of uncertainties here are ignored. That is what we say the exact value are used to calculate the life cycle costing. And for probabilistic approach, cost parameters are assigned with some appropriate probability distribution, such as random numbers. You generate a random numbers. Then from the random numbers, you calculate your life cycle costing. So calculation on life cycle costing must involve some costs. These costs are delivery and installation costs, that is initial cost, energy cost, operational cost, maintenance cost, downtime cost, the commissioning or disposal cost. And there is a formula. This cost involved must be added together to give you life cycle cost of a product. For example, you must add, if you want to find a life cycle cost of a product, you must add all the initial costs, the delivery and installation cost, energy cost, operational cost, maintenance cost, downtime cost, plus the commissioning cost. Finally, you find your life cycle costs of any product you want to make the analysis. We have some case studies of a light bulb. Assuming there is a company which wants to buy light bulb for one of its offices, and they want the bulb to work for 10,000 hours. And they have two possibilities, or they have two alternatives. The first alternative is to buy 100 watt incandescent bulb. The second alternative is to buy 25 watt compact fluorescent bulb. Now, the task for the economist or for the analyst left is to calculate the whole life cycle cost of both alternatives and decide which one is better for the company to use. So the cost of light bulb can be divided into two main categories. You can find the initial cost and also operational and maintenance cost. When you find these two, you add them together, then you find the LCC of each bulb. Now let's take incandescent bulb. The initial cost of incandescent bulb, cost of one bulb will cost you 25 Malaysian ringgit. And the life expectancy of that one bulb is only 1,000 hours. So if you want to know the number of bulbs needed to burn 10,000 hours, you must find out 10, because since one bulb is 25, you can now say 1,000 times 10,000 will give you what? 10,000 hours. So total payment to light the bulb for 10,000 hours will be what? You now say 25 Malaysia ringgit times 10 will give you 250. This is the total payment of the bulbs that will burn for 10,000 hour of incandescent bulb. So it means that the initial cost of incandescent bulb is 250. Now operational and maintenance cost of incandescent bulb. We now finish with the initial cost. Now what is the operational and maintenance cost of such bulb that cost you 250 Malaysia ringgit? Now hours required to use 1 kilowatt of electricity for a 100-watt bulb will be what? 1,000 divided by 100, which is equal to 10 hours. Then kilowatt of electricity in 10,000 hour will be what? 10,000 hour divided by number of hours, which will give you 1,000 kilowatt. Total cost of electricity used. Supposing that, or we can just take that 1 kilowatt will cost 160 Malaysia ringgit. Now we can say 160 times 10,000 will give you what? 16,000 Malaysia ringgit. And this 16,000 Malaysia ringgit is the total cost of operation and maintenance of incandescent bulb. Now, let us see the compact fluorescent bulb. Initial cost of compact fluorescent bulb is 1,500. That is one bulb, that is compact fluorescent bulb. And the life expectancy of this one bulb is 10,000 hours. So there is no need of buying many because it is one and it costs you 1,500. So total payment to light the bulb for 10,000 hour will be what? 1,500. You just buy one, and that one is 1,500. So the initial cost of such compact fluorescent bulb is what? 1,500. So there is no need of timesing this by this. So operational and maintenance cost of this. Hour required to use 1 kilowatt of electricity for a 25-volt bulb is what? Then we now say 10,000 or 1,000, that is kilowatt, divided by what? The total of the watt, that is 25, which will give you 40 hours. Kilowatt of electricity in 10,000 hours will be what? This 10,000 divided by the number of hours. Number of hours, that is 40, which will give you what? 250 kilowatt. So the total cost of electricity used, we supposing that the Malaysia ringgit as before is 100 and for 1 kilowatt cost you 160 Malaysia ringgit. So now we can say 160 by 250 kilowatt will give you 4,000 Malaysia ringgit, and 4,000 Malaysia ringgit is the cost of maintenance and operation for the compact fluorescent bulb. Now, based on these two analyses, now you have to take the initial cost and operational cost and add them together to give you the life cycle cost of each bulb. When you take incandescent bulb, 250 Malaysia ringgit plus 16,000 Malaysia ringgit will give you 16,200 Malaysia ringgit. That is the life cycle costing for incandescent bulb. And when you take compact fluorescent bulb, 1,500 plus 4,000 Malaysia ringgit will give you 5,500 Malaysia ringgit. That is the total cost, total and maintenance cost for incandescent, for compact fluorescent bulb. Here, if you can judge which one is the highest, definitely we know 16,250 is higher than 5,500 Malaysia ringgit. So if you are wise enough, which is almost 3 times or 4 times than the first one for the incandescent. If you are wise enough, based on this analysis, the company may choose to buy 5,500 compact fluorescent bulb for the, which is more suitable for their company, more economical and suitable for the company. So this is the analysis. This is the graph showing the analysis of life cycle cost of incandescent and fluorescent, incandescent bulb and compact fluorescent bulb. Now the decision made by the economist or the company. The compact fluorescent bulb is this less expensive over its life cycle than incandescent bulb. Hence, compact fluorescent bulb will be more proper to use for the company to buy for long-term use because it will prove to be more economic in long term. Advantages of life cycle costing. It has many advantages, life cycle costing, and it has also disadvantages besides. The advantage of this life cycle costing is one, improved forecasting. The application of life cycle costing techniques allow the full cost associated with a procurement to be estimated more accurately. If you use whenever providing a product, producing a product, or building a company, or initiating something, and you include life cycle, you do a life cycle costing, definitely you must find you can estimate the accurate costs that you will incur, that will be incurred in the production. Then secondly, improved awareness. Provide management with improved awareness of the factor that drive cost and the resources required by the purchase. Yes, what factor drive this cost? What are the factors that drive the cost of the products? Then thirdly, performance trade-off against cost. Life cycle techniques not only focus on the cost, but also consider other factors like environmental effects, the quality of goods, and level of service to be provided. This is the disadvantage of the life cycle costing. One, time consuming. Life cycle costing analysis is too long because of changes of new technology. There are a lot of new technologies day by day that is changing. So it is time consuming. Maybe you find something today, but tomorrow, as a result of the new changes, it may change in terms of maybe cost or something. Then secondly, it is costly. The longer the project lifetime, the more operating cost will be incurred. Third, technology. Always technology is not dynamic, it's changing day by day. There are a lot of new innovations. Today you may find this, but tomorrow it may change to new innovation. You need to go back and find out what is the advantage of the new innovation and what are the advantage of the old innovation. So for this, can see life cycle cost projection. A complete life cycle cost projection analysis may also include other costs, as well as other accounting financial elements. Such accounting and financial elements are interest rates, depreciation, value of money, discount rates. If you want to do a full projection, full analysis of life cycle costing, that is from the beginning of the product to the end of the product, from cradle to grave, you must involve all financial, all other costs or financial elements like interest rates, depreciation of the currency, value of money, discount rates. For this, you have to go back and do some findings on these interest rates, depreciation, present values. Now, there is a present value, how to calculate the present value. This present value can be used to calculate the entire design life, which include all costs, including replacement cost and disposal cost. And here is the formula. And here is the explanation of the formula. And you can use the interest rate on money used elsewhere. You can use 5% or 10% discount rate. So this is the end of the lecture today. Thank you for listening. And here is a reference book that you can discuss extensively deeply on environmental life cycle, or the whole life cycle, or the three life cycle costing, which are conventional, environmental, and societal life cycle costing. Thank you very much, class. Thank you for listening. Subhanakallahumma wa bihamdik wa ashhadu an la ilaha illa anta astaghfiruka wa atubu ilaik.